Welcome to the first of a two-part session where we take a look at performance measurement and performance management. In the first part, we're going to take a look at market performance indicators. The second, we'll have a look at the way that shareholder value is created and measured using something we'll talk about later, the DuPont system of ratios. In this session, we want to know how the market perceives our company and how performance is essentially represented in market information. If we think about the stock markets, essentially what we have is a very democratic system with millions of individuals, generally well-informed individuals, expressing their opinion of the value of a company, whether it's overvalued or undervalued, by buying and selling. And they're doing this with such frequency that essentially the market finds its own level. If a stock is supposed to be worth $100 because the future cash flows of the company, discounted according to timing and for a certain level of risk, set the price at a certain level, well, essentially the market is giving us that information. And if the market works well, stock markets and what they think are very important. Essentially, when we think about this information, you can imagine that if an analyst could hire lots of comparison shoppers who would go into the market and always find the best price. Well, in this case, they're looking for the best price in a company through constant trading. If we believe, as most economists do, in some form of efficiency of markets, something that, many of the financial economists of the past, probably starting with Louis Bachelier, other people like Paul Samuelson, eventually Eugene Fama, created an idea or a concept. They put forward the theory that markets will collectively be efficient, even though they may be inefficient for a moment or two, that they may take a certain amount of time to absorb information. But if you believe that this information does give us the true value of a company, essentially you'd say that market information may be more valuable than what the accountants are telling us is the truth from the accounting information. The market performance ratios that we'll be talking about today demonstrate that if there's a change in the investor's beliefs in the future of the company, that will ultimately be reflected in the share price. So, how do we express this interest in the stock market? Some of the measures that we're going to talk about today include things like the earnings per share, price-earnings ratios, and some of the other ratios that we describe as market multiples, like price to sales, price to cash flows, market to book values, and enterprise value to profit ratios. We won't go into a lot of detail in all of these, but we'll take a look at some of them, and in particular, the most commonly used market ratios. In fact, I've provided in the VIU Learn shell for your course a short teaching note called Analyzing Financial Performance. It goes through some of the most important features, but they're also covered in two of the chapters that we have in our book, in our course textbook. The most common, in fact, probably the most widely cited statistic that we use for businesses is the price to earnings ratio. And it is exactly what it says, the share price divided by the earnings. If we look at it on a company scale, the entire value of the company divided by the total earnings of the company, or on a per share basis, we describe it as the share price quoted today or quoted on an average for perhaps the last year, divided by the earnings per share. Earnings per share, a relatively simple statistic in its definition, earnings per share. The net income of the company divided by the number of shares outstanding. But as we'll see later, that can also be a little bit complicated. Many years ago, when I was doing a course for a company called United Utilities, essentially a water and sewer and electricity company operating in the north of England, and I was dealing with a lot of engineers, I used this example to explain what earnings per share was. In their case, they saw that the price-earnings multiple for their company was 10.5. According to these folks, their company was the best company ever invented. And yet, look at all of these other price-earnings multiples. Much, much higher. Something called quality software that most people had never heard of had a 57 times multiple. A pharmaceutical company that had just recently been split off from another chemical company called ICI had a 22 times multiple. British Gas had a 9 times multiple, and even Harry Ramsden's had a higher multiple. Well, if you're in the north of England, you know Harry Ramsden's is actually a fish and chip shop chain. And they had a 38, 39 times price-earnings multiple. So how could these companies be so much better? Well, it's not a question of being better, but this is a statistic that conveys a lot of information, not just about the quality of the company or the quality of the management. United Utilities is a utilities company. They produce electricity, they produce water and sewer services, which they sell to customers, and pretty much their cash flows are stable and safe. They generate a reasonably high profit on a very regular basis because they're regulated utilities. So the government regulator tells them how much profit they can make. There can never be a surprise in their earnings. And their ability to grow their business is also quite limited because if they want to increase their sales by 10%, they need more power lines, they need more water systems. It's not easy to grow that business quickly. And for that reason, they're a lot like British Gas, which essentially had many of the same demands and was part of the same regulatory framework. So they were doing a little bit better than British Gas, and that was a good and useful bit of information. Quality Software, on the other hand, was doing very well because it was a fast-growing business, but also because its earnings were very small. It was in the development stage, so very small earnings divided by any share price will give you a relatively high price-earnings multiple. In fact, as their earnings go to zero, their price-earnings multiple goes to infinity. Harry Ramsden's, same kind of thing, a lot of growth prospects, because even though it's a fish and chip shop, they were expanding internationally. They'd set up operations in Hong Kong. They had a licensing deal with McCain's Food to sell their French fries. And so they had a high price-earnings multiple, but their earnings were actually relatively low, which eventually led the company to get into trouble. They had growth without earnings. Zeneca and ICI were also an interesting story because earlier that year they'd both been part of the same company. And because the people at ICI said that Zeneca was holding them back, they decided to split the company into two and create Zeneca shares and ICI shares. Now, the only reason Zeneca was so high was that they were in the middle of a takeover deal. A company called Astra, a Swedish company, was about to take them over. That meant the price was bid up, and it more than doubled the price-earnings multiple. Again, nothing to do with the quality of the company or even the quality of their drugs. It was just about the fact that they were part of a possible bidding war with several suitors looking to buy the company. That tells us, or it gives us an idea of some of the problems that we have with using price-earnings multiples. If we think about price-earnings multiples, we have a problem of time, a temporal problem. We think about the price. The share price is essentially the present value, and you've heard that term before, the present value of the future cash flows. If we think the company's going to make $100,000 or $100 million in earnings every year from now until infinity, that will allow us to calculate the present value of the company, and that's what the shareholders are thinking about. How much risk, how much return, what's the timing? The earnings per share, on the other hand, is based on the past, last year's earnings. And we see this all the time where we get a company that's had a very bad year. Its earnings have been very low. Well, low earnings is going to give us a much higher price. And if the company's prospects are very good, we'll have a very high price and therefore a high price-earnings multiple. The opposite could also be true. If last year was a fantastic year for the company, their earnings per share were at a record, and well, they've got some bad news perhaps looming in the future. A change in regulation that's going to affect them. Perhaps they're in a fossil fuel business. That could also depress the future value of all of their earnings. And so this means that the price earnings multiple is always going to be dogged by this problem of timing. And what makes it even worse is that the earnings that we're talking about in a historical view of the price earnings multiple can be from a time 18 months earlier. Sales that we reported 6 months ago that are based on sales that were done a year before that. So the earnings information may become quite stale, but we can fix that, and we'll show you how to do that in a minute. When we take a look at a company and their price earnings multiple, we can see that it changes over time. This is an example that I drew a little bit earlier in the beginning of last year, and we could see that Apple, here shown by their ticker symbol AAPL, their NASDAQ ticker symbol, says that they were trading on the day that I looked at 26.61 times. Over the previous year, the price earnings multiple had fallen as low as about 14 times, and in the earlier years before that, perhaps as low as 12 times. Now, is that a sign that the company was in trouble? Actually, the company has had record sales. So very high earnings start to make people question what are the prospects for the company in the future. Will they be able to continue their innovation at the same rate that they have? Will they be able to produce new iPhones and iPads and computers? And Apple produces services as well. If people start to lose hope in the future, no matter how high their earnings are, their price earnings multiple will fall. And at some point as well, in that year, the markets could have generally been lower. So market sentiment also helps to boost the company's price earnings multiples, as it is reported. There are problems with timing, as I mentioned earlier. In the most common price earnings multiple, we report the historical earnings per share. We call that a trailing price earnings multiple. We could also use a forecast of earnings. I show you how that's done in the teaching note that I've provided. Essentially what we're doing is we're checking with analysts who look into the company, who report on the company, and when they write the report, they tell you how much the earnings per share is expected to grow from this year till next year and to the year after that. And then one organization, perhaps Morningstar or Bloomberg, will collect all of the different opinions from the investment bankers who write these reports, and they'll take an average, the consensus forecast earnings per share. When they're using that forecast earnings, not the historical information, that gives us a leading price earnings multiple. When we hear about a historical price earnings multiple, quite often that's based on the last year's earnings per share and the last year's average share price. We can also use the earnings per share for the last 12 months, regardless of when their year end was. Companies provide reports on a quarterly basis. So in a trailing 12-month model, what we do is we take the last 4 quarterly reports and we take the sum of the earnings per share for each of those quarters. In this example, you can see that we have quarterly information from October, July, April, and January of 2020. Those were the 4 most recent annual reports that had been provided when I downloaded this information about a week ago. Their EPS for each of those quarters is shown here. And we see a couple of things. Number one, the earnings per share has improved a lot, and it's improved over the previous year. So the earnings per share is rising. Our earnings per share for the trailing 12 months is $35.14. So that news is telling us, or would make us expect, that unless the share price is really going up, the price earnings multiple would be coming down. In fact, that's what we see. We can also make other adjustments. We don't go through them all here. In fact, this is a survey course. We introduce a lot of concepts, but we leave it up to you to carry this forward, to look into this more detail. Sometimes price earnings multiples are adjusted for leverage because the company's growth comes from both the investments of its shareholders and its bondholders. And so by taking out the part attributable to bondholders, we adjust for leverage. Sometimes companies don't have positive earnings per share. So we can't calculate a price earnings multiple if the EPS is 0 or negative. It becomes meaningless. If you have a fast-growing industry, which everybody's investing and nobody's making a lot of profit yet, a price-to-book value ratio makes much more sense. In fact, that's also the case when we use a price-to-sales ratio. That may be one of the simplest ways, especially in an industry that's in the early growth stages. We can't always compare price earnings multiples between companies because of the difference in their industries, and you saw that in the first example that I used. It's also difficult to compare price earnings multiples over time. If you looked at a price earnings multiple early in this year, share prices were down, but earnings were still quite healthy because they were riding the high of a very long bull market that we've seen. So earnings per share were high, but prices dropped because of the pandemic. As a result, price earnings multiples crashed. That wasn't the fault of the company, that was the problem of the market. And we say that a great saying in finance, a rising tide lifts all the boats. In a fast-growing market, all of the price earnings multiples rise for great companies as well as good companies as well as poor companies. So be careful. When you're comparing between companies, you may be making mistakes, and also when you're comparing over time, you're definitely going to be making some mistakes. For those multiples, and I have said we're not going to go into these in a lot of detail, I provided some comparisons that you'll see here. They're in the slides. These ones aren't in the teaching note. I've got Apple, Dell, Google, Amazon, and then I have the average for the Standard & Poor's 500 index. Now, you can see here by looking at the trailing price earnings multiple, Apple was at about 26 times, Dell at 9, Google at 30, Amazon is at 83 times. One of the fastest growing businesses. Its growth is reflected by that high price to earnings multiple. But all of these companies are doing pretty well because the average for the largest companies in the United States is sitting around 22 times on the day that I downloaded that information. Now, you'll see that if I use the leading price earnings multiple, using the forecast earnings per share and today's share price, I've got a much lower price earnings multiple for Apple. And that's because the analysts believe that the earnings per share are going to rise. That's why they have a lower price earnings multiple. So growth, high growth, actually deflates the price earnings multiple. Same thing for Dell, same thing for Google, and especially true for Amazon, because the earnings per share were expected to rise. And you know, even though the share price has risen above what it was on the day that we saw this price by about 170%, their earnings per share have risen even faster. And that's something that you'll see in the teaching note. Price to sales is another great way of looking at this. Their share price divided by the sales divided by the number of shares outstanding. That gives us an indicator that's actually quite appropriate for certain industries. We have a hard time valuing technology companies with negative earnings per share. And so this one will tell us that in a fast-growing industry, these are the strongest players. 5 times, over 5 times for Apple. Very low for Dell, but they're a very new company in a strange way because they've just been reconstituted. Google, about 6 times price to sales. And Amazon has actually got the lowest price to sales ratio. Their sales are huge, of course, because they are like a retailer. They get a small margin, 3 or 4%, over a very large volume of sales. So their price to sales ratio, much lower than Google, much lower than Apple. And when Dell stabilizes, I imagine it'll be much lower than theirs as well. In fact, it's much lower than the index. These are all underperformers. Price to book, the total value of the company, the enterprise value, divided by the book value of all of their assets. So how much of the company's valuable is essentially intangible, is the prospects of growth that are incorporated in this. For Apple, it's about 15 times. There's an awful lot of intellectual property that gives Apple its value. Although Apple's a bit funny, when you look in the accounts, you'll see there's a lot of cash in their business, and that distorts this number. For Amazon, though, it's about 27 times. So that is an incredibly high price to book value ratio. In fact, anything better than 1 essentially means the company has created shareholder value successfully. The average for the industry is only 3 times. Price to cash flow, the ability of the company to create value from cash, is similar to price to earnings ratio, but done on a cash basis. And enterprise value to operating profit, or EBIT, is the total value of the company, total value of the enterprise, divided by its operating profits, essentially the rate at which it creates shareholder value from operations. And this number is remarkably high for Amazon. Again, we're just giving you a taste of this. This is just a flavor. It's not like this is something that you'll have to memorize to be on an exam, but you do have to know, as in any toolkit, which tools are the ones that you're going to be able to use for which job. And that's the judgment part. Some of these are going to be valuable for most situations, but in other situations, they'll be misleading. There has been a lot of study of price earnings multiples, and one of the problems that we know that we have with price earnings multiples is that they tend to be very high during boom times. This is a very long time series of price earnings multiples, going back to the 1880s, where perhaps the norm was about 18 times price earnings multiple, and kind of normal volatility, but from the 1900s or 1905, we have a major panic, 1903, sorry, major panic. And then by the time we get to the 1920s, we have a major depression, and price earnings multiples fall to 5. Some of the best companies in the U.S. market were worth much less than they had been a few years earlier. They were a bargain. That was the time to buy. But people believe this is the end of the world. Sell your shares, put your money into something valuable, like gold or wristwatches or art, but get it out of the financial market and into the real asset market. Very bad mistake, because a few years later, we see the market has inflated to about 30 times price earnings multiple. Then we have the market crash in 1929, another bubble in the 1930s. The ones that I remember, 1987, while I was an MBA student, we had something called Black Friday, a complete market crash. And at that time, they said the market was overpriced. It was only about 15 times. The dot-com bubble, we saw the market valued at about 45 times. And today, I think around 27 times. Still pretty darn high compared to historical averages. Now, this is essentially an approach that's been followed by academics, especially Robert Shiller, who says that we need to be able to use an adjustment for business cycles in order to take some of the boom and the bust out of our appreciation of what a fair market return is. Again, we might come back to that one a little bit later. Another term that I wanted you to be aware of, as well as the price earnings multiple, is the earnings yield. Earnings yield is a lot like price earnings multiple. In fact, it's its reflection. Essentially, the earnings yield is just a simple twist on the price earnings multiple. We use the reciprocal. So if we have, for example, 25 times price earnings multiple, and if that was the case, we'd say that we have our share price is going to be 25 times our earnings of $1. That gives us a 25 times price earnings multiple. Very simple calculation. Well, if you wanted to see what that looked like as earnings yield, we would just take 1 divided by 25 over 1. And that would be about 4%. Or we could just take 1 over 25. That would simplify and give us the same amount. We just flip the ratio on its head. Well, what does 4% tell us? That tells us the rate of return at which the market is going to expect our company to pay out. If you're going to earn $1 on your share every year, it's going to take you 25 years to pay back the principal, the $25. Or essentially you require a 4% rate of return. At 25 or 26 or 27 times price earnings multiple, the earnings yield is very low. So you must be counting on growth rather than earnings to fuel the business. And so that is simply an example that I talk about in the teaching note. Now, essentially, what we're saying is that the investors are happy to buy the stock if it provides an earnings yield of 4%. At 3% or 2%, no, and at 5%, it looks like a great bargain. So that is another alternative approach to understanding our price earnings multiple. We also threw out the term earnings per share, and I know you've heard this one before. Essentially, we calculate the earnings per share by taking the earnings and dividing them by the number of shares. To be a little bit fancier, we'll take the net income minus any preferred shares, preferred dividends, because the preferred shareholders' money is not something that our common shareholders are interested in. We divide it by the average number of common shares that are outstanding. Simple calculation. At least that's the theory. In practice, it gets a lot more messy. There are a lot of accounting issues with the calculation of earnings. Essentially, there are problems with dilution. If the number of shares can be increased, that would also be a problem. And there may also be adjustments for things like extraordinary losses or company restructuring, things that aren't likely to happen again. They can also be confused because accountants, when they put together the financial statements of the company, make a number of decisions that may, with hindsight, seem to be arbitrary. A decision to write off certain kind of assets, a decision to transfer or to translate foreign exchanges at different rates for assets versus income. And there are also different accounting rules. Most countries in the world are moving towards full acceptance of IFRS standards, but the United States still uses a very different approach with its GAAP, its generally accepted accounting procedures. So that may mean that two companies, a British and an American company, a Chinese company, and an American company, might report their information and their earnings very differently. We see that if we're looking at a company's results over a period of years, there's more consistency than if we're looking at a number of different companies in the same year. So we see that there's consistency over time, but inconsistency across geography. So that may be a big problem in the interpretation of our EPS. And there's another problem, earnings per share. Earnings are very hard to improve. You can perhaps cut some of your costs, lay off some people, shut down a factory. You can increase volumes to get some kind of improvement in your overall earnings, but that's hard to do. Much simpler to change the number of shares. And the simplest thing we could possibly do would be to reduce the number of shares outstanding. All we have to do is borrow some money from the bank and use them to buy back our shares, or use some of our spare cash flow to buy back our own shares. A big part of business practice, especially in the last few years, as companies are sitting on larger piles of cash, and they decide that the fastest way to improve the prospects of the company, repurchase shares. So either by using debt or by using your spare cash, reduce the number of shares, shrink the denominator, and the price earnings multiple will improve, and it'll make the company look good. The share price will go up even more. Managers who are rewarded with stock options will see the value of their options increase. So that has got to be part of the explanation for the manipulation of earnings per share. We should never really use earnings per share to compare different companies. The most common reason for that is that the companies have different types of structures. I noticed when I took a look at Investopedia, here they've got on a single axis the results of some of the biggest technology companies in the United States. And so we'll see that one company is doing better than the others. For example, what have we got here? Google has got the highest earnings per share It's improving, and that over time is interesting. But how does Google compare to a company like Netflix or Tesla or Ford or Microsoft? Some of those companies have got are very small, and so an earnings per share of $30 might be fantastic. If your company's only worth $100, it's a 30% yield on that company. Another company can have a share price like Amazon of $3,000 or almost $4,000. And if that's the case, then $30 return on $4,000 is minuscule, about 1%. Not nearly as good. So in straight dollar terms, EPS is not comparable between companies, but it might be interesting over time. We can see what the trend has been. A couple of ratios that are worth mentioning. You don't have to do a lot with these, but I want you to know they're there. Price earnings are a combination of two things: earnings expectations, but also growth, the present value of the growth opportunity. And we get information about that from something called the price earnings to growth ratio, the PEG ratio. Or perhaps if we're going to look at that, we could just divide PE, put some brackets around that, and then divide all of that by growth. Sorry, that's not very good writing. PE divided by growth. And here essentially all we're doing is we're taking the price earnings multiple and we're dividing it by the expected growth in earnings per share. So if we have a company with a 25 times price earnings multiple and we divide it by 10% growth, 25 divided by 10 gives us a 2.5 is the PEG ratio. If we have a company which has got a very low PEG ratio, that's because, well, growth is relatively high and the PE is low. And if that's the case, then the company may be a bargain because its growth is going to give it great value in the future. It could also be the company is on its way out. As they say, it's a dog. If we have a P to G ratio of 1, it may represent a value where there's a balance between the earnings yield and the growth, so they're essentially balanced at 1. It may be an oversimplification, but it's a good way of looking and comparing different types of companies. In the next slide, you'll see that we have an example of several companies in the beverage business. We have information here. We have a trailing price earnings ratio. We have growth. We have 29 times price earnings, and we have 9% growth. 29 divided by 9.5% gives us a PEG ratio of 3. And that's pretty high. In fact, when we compare it to some of these others, well, we've got PepsiCo. They're a little bit higher. And we've got somebody called Todd Hunter International that is also pretty high. We've got some others that look like they're bargains. Brown-Forman in the alcoholic beverage end of the business, or perhaps Boston Beer, have much lower price earnings to growth multiples. Now, we can also use that or compare that to the standard deviation and see how much volatility. Companies like Coca-Cola, like PepsiCo, have got relatively low standard deviations or volatility. And so the less volatility, the more comfortable we are with those numbers. A combination of low volatility and a low P to G ratio would suggest that that looks like a real bargain. Again, we're just doing this as a bit of a survey. Don't get too worried if we're getting a little bit ahead of you now. I get a lot of the information that I use when I'm looking at PG ratios from another academic website produced by a professor at New York University called Aswath Damodaran. In fact, there is a link on this page where you can see the most up-to-date information. Aswath has got more doctoral students than anybody that I've ever met. And basically, if you're one of his doctoral students, you spend a lot of time collecting data, putting it on the computer, and then he makes it all public. And so you can use it for your research or help other people with theirs. So this is a good common database. Here we've got information about trailing price earnings multiples and forward price earnings multiples, growth, and PG ratio for different sectors. And when you look at this, you'll see that some of the sectors with the highest PG ratios are ones like basic chemicals, food wholesalers, perhaps metals and mining. And some of the industries that look a little bit more like a bargain include broadcasting, air transport, and retail. Now, mind you, this information is out of date. I wouldn't make any decisions based on it. But it does tell you that at the time this was produced, this is the difference. This is what you expect to see for certain industries. And with industries, you can compare to see who the highest and the lowest performers are. Now, we're also interested in the corporate level version of the price earnings multiple. We describe that as Tobin's Q, or the market to book value ratio. Essentially, that reconciles the insights of the market and the recorded information from the accountants. And it puts those together, and we say that if you have a really high market to book value ratio, if you have a high Tobin's Q, your company must contain a lot of value that the accountants have missed. Look at a company like, I don't know, perhaps Tesla or Apple, Amazon, Netflix is a great example. There we have companies who have a lot of intangible value. They've created business models that are hard to copy. Perhaps they have client relationships that are going to be set in stone, that can't be broken. They may have some kind of trademarks or brands that have not been capitalized and are not shown on the balance sheet. That would give them a high market to book value ratio. It tells you a lot about the industry, not necessarily whether or not the company is good or bad. If the market to book value is lower than 1, then that means you could actually go out and buy the company cheaper than you could buy all of its assets. So, in other words, why would you build a company when you can buy a whole company cheaper? Kind of like if you could go out and buy all the parts for your car for $500, but the car itself would cost $10,000. Wouldn't you just buy the parts and put them together if you knew how? Well, a low Tobin's Q may be an indicator that the company is perhaps failing, or perhaps it's time to take it over. So if the value is greater than 1, it means we've got a company with lots of intangible value. Below 1, we have a company that's perhaps in trouble. There are a number of other reasons for a high market to book value ratio. If you're in a hyperinflationary economy, or a company that's been built over decades, perhaps even a century, many of their assets may be underpriced because over time the value's grown. If somebody bought a building for $1 million in Vancouver 20 years ago, and you look in their books, the book value of that building is still $1 million. Well, the market value might be $20 million because over time the market has risen, and the accountants do not revalue the business, do not revalue the value of that building. So higher inflation might also be a reason why the average market to book value would be greater than 1. Sometimes it's a good way to spot bargains. In fact, if we see this example, this is from an article that was looking at silver companies. Now, mining companies in general tend to have relatively low market to book value ratios because they're only worth as much as the reserves of the business are priced at, and they're constantly revalued. Here we've got a number of mining companies in silver and gold who all have a market to book value ratio of less than 1. The cheapest is Allied Nevada. They have a market to book value ratio of 0.42. It suggests you can buy this company for about 40% of the value of their reserves. Now, I don't know what the catch is. I'd do a lot more research before I put real money into that investment. But this suggests that's a bargain. Other companies, all the way down to perhaps Silvercore, Dominion Diamond, have significant discounts on their book value. So it would suggest that as long as the price of gold and silver doesn't fall, these would be bargains. We don't know why they're so cheap, but the implication of the articles, perhaps these are ones that are worth looking at. That is an awful lot to look at in such a short video. This is an introduction. Now, you've got a couple of chapters to look at. There's the teaching note to read. And in the next session, I'm going to talk a little bit more about creating shareholder value. But what you need to take away from this session is that these market indicators are based on the presumption of efficient markets. The market knows what's happening. Maybe not perfectly, maybe not in real time, but the market has got a good sense of what the value of company is going to be based on its future cash flows and its prospects. It's consistent with FAMA's efficient market hypothesis, and so academics tend to like it. And it works alongside of the analysis that we're going to look at next, the DuPont analysis for shareholder value. I'll see you in that next video, and thanks for joining me today.